Hello, welcome to this week's Private Funds Update. I'm Sandra from SmartSQ, and today is Thursday, April 9th, 2026. We've got a massive show today: a simplified revolution in Saudi Arabia, a fresh SEC warning on disclosure gaps, and a landmark Delaware ruling where AI became the star witness in a broken deal. Let's dive in. First, we look to the Middle East, where Saudi Arabia's Capital Market Authority has officially moved to democratize its private markets. The new Simplified Investment Fund instructions are now in effect, significantly lowering the barrier to entry for fund managers. By streamlining the formation process and reducing administrative overhead, the kingdom is signaling a massive push for regional venture and private equity growth. For global GPs looking to tap into that $900 billion public investment fund ecosystem, the technical hurdle for launching a local vehicle just got much lower. In the US, the SEC has issued a stark reminder that checking the box on compliance simply isn't enough. In Administrative Order IA 6954, the Commission charged an investment advisor for systemic failures in disclosing conflicts of interest. The case centers on an advisor who failed to properly notify LPs about financial incentives received from third-party service providers. This isn't just an ethics failure, it's a process failure. As the SEC weaponizes disclosure audits, GPs must ensure their internal engines are proactively flagging these hidden conflicts before the regulator does. Pivoting to the UK, the Financial Conduct Authority is officially consulting on a major overhaul to simplify pensions and investment advice. The FCA's proposed framework aims to streamline ongoing advice rules, acknowledging that the current one-size-fits-all compliance burden is stifling the market. For asset managers and pension providers, this shift signals a rare moment of deregulation. However, simplified doesn't mean unregulated. Firms will need a more surgical approach to compliance data to navigate this new, more flexible regime. Finally, a landmark warning from the Delaware Court of Chancery. In a case involving a failed earnout strategy, the court used a buyer's own AI chat history as the star witness to prove they acted in bad faith to avoid making payments. The court even equitably extended the earnout period to remedy the buyer's breach. This is a massive wake-up call for the C-suite. If you are using unguarded horizontal AI to discuss deal strategy, you are essentially creating a discoverable roadmap for your own litigation. In 2026, if your AI doesn't have expert logic guardrails, it isn't a tool, it's a liability. That's your briefing for this week. You can learn more about these topics from me on the SmartSQ platform. If you are curious about the services we offer, please visit www.smartsqi.com.